Have you ever pondered why so many individuals are magnetized towards the stock market? It's not just about buying and selling shares. It's about the potential for financial growth and prosperity. The stock market is a fascinating ecosystem where companies, big and small, can raise capital by selling shares of their business, and where investors, like you and me, can become part owners of these companies. By investing in the stock market, we are essentially betting on the future success of these companies. When they flourish, so do we, as our investments appreciate in value. The allure of the stock market lies in its ability to create wealth over time. It's a place where patience can pay off, where strategic decisions can lead to substantial financial rewards. But remember, the stock market is not a get-rich-quick scheme. It's a platform for long-term investment requiring careful planning and informed decision-making. It's more than just a platform for buying and selling shares. It's a gateway to financial prosperity. Now, you might be questioning, why should I invest in the stock market? Well, let's explore some of the compelling reasons that make the stock market an attractive investment avenue. First and foremost, the potential for high returns. The stock market over time has proven to be a wealth-building machine. When you invest in stocks, you're essentially buying a piece of a company's future growth. As the company thrives and expands, so does your investment. It's like planting a seed and watching it grow into a mighty tree. Sure, there are periods when the market dips or even crashes, but historically it has always rebounded and continued its upward trajectory. Secondly, when you buy a stock, you are buying a piece of ownership in a company. This ownership stake lets you participate in the company's success. As a shareholder, you have a claim on part of the company's assets and earnings. You may even have voting rights at shareholder meetings. It's not just about the money, it's about being part of something bigger, a part of the company's journey. And then there's the ease of liquidity. Unlike some other forms of investment, like real estate, for instance, stocks are relatively easy to buy and sell. With the click of a button, you can become an owner of a company or let go of your ownership. This ease of access and the ability to quickly convert your investment into cash is another big plus of investing in the stock market. Lastly, the stock market offers diversification. With thousands of stocks to choose from, you can spread your investments across different sectors, reducing the risk of putting all your eggs in one basket. As you can see, the stock market offers opportunities that traditional investment methods might not. It's not just about making money. It's about being part of a company's growth story. It's about the thrill of watching your investments grow and multiply. And it's about the ease and flexibility of managing your investments. So why not consider taking that first step into the world of stock investing? You might just find that it's an adventure worth embarking on. However, it's not all sunshine and rainbows. The stock market carries its own set of risks. Just as the possibility of earning sizable profits is real, so is the potential for loss. The stock market is a volatile entity, often influenced by global events, economic factors, and corporate performance. Prices can fluctuate wildly from one day to the next, making it a high-stakes game of prediction and timing. Investing in the stock market is not akin to a casual stroll in the park. It requires a significant investment of time and effort. Extensive research is a must before investing in any stock. This includes understanding the company's financial health, its competitive position, industry trends, and even the overall economic climate. Another risk factor is the potential for loss. Unlike a savings account that guarantees your principal amount, there's no such safety net in the stock market. There is always the possibility that the company you invest in could underperform or worse, go bankrupt, leading to a partial or even total loss of your investment. Despite these risks, many are drawn to the stock market for its potential for high returns. But remember, higher potential returns also mean higher risk. It's a delicate balance, and every investor must carefully consider their risk tolerance and investment goals. Risk and reward go hand in hand in the stock market, so tread carefully, do your homework, and make informed decisions. When it comes to investing, it's crucial to understand the difference between debt and equity. Let's start with debt. In simple terms, debt refers to borrowing. When a company needs money, it may borrow from banks or issue bonds. As an investor in debt, you're essentially playing the role of the lender. You lend money to the company, and in return you receive interest payments and eventually the return of the principal amount. You could think of it as a sort of IOU. The company owes you, and you hold the promise of being paid back. On the other hand, equity signifies ownership. When you invest in equity, you buy shares of a company, becoming a part owner. As a shareholder, you share in the company's profits and losses. Your returns come in the form of dividends and capital appreciation, which is the increase in the stock's price over time. Unlike debt, where your returns are predefined, with equity, the sky's the limit. But remember, the risks are also higher. So, how do these differ? The main difference lies in the risk and returns. Debt is generally considered safer with fixed returns. Equity, on the other hand, offers potentially higher returns, but with greater risk. Also, in case of bankruptcy, debt holders get paid before equity shareholders. Understanding these two fundamental concepts can significantly influence your investment decisions. So you're ready to invest, but wait, what should you consider before diving in? As any seasoned investor will tell you, investing is more than just throwing money at a stock and hoping for the best. There are several key parameters you should consider before making an investment decision. Firstly, you should look into the company's financial health. This can be assessed by reviewing its financial statements. Look at the company's earnings, its profit margins, its debt levels, and its cash flow. A company with a strong financial profile is generally a safer bet. Next, consider market trends. What is happening in the industry in which the company operates? Is the industry growing or shrinking? A growing industry can provide a tailwind for a company, while a shrinking industry can make life difficult even for a well-run business. But don't just stop at the industry level. Consider broader economic trends as well. Is the economy in a growth or recession phase? The answer can have a significant impact on a company's prospects. Thirdly, take into account your personal financial goals. Are you investing for long-term growth, or are you seeking income? Different stocks can serve different investment goals. Growth stocks, for instance, are more likely to reinvest their profits to fuel expansion, while income stocks often pay out a significant portion of their earnings as dividends. Don't forget to consider your risk tolerance as well. Stocks can be volatile, and their prices can fluctuate widely in the short term. If you can't stomach the thought of your investment value going down, even temporarily, stocks might not be the right choice for you. Lastly, remember that diversification is key. Don't put all your eggs in one basket. Spread your investments across different companies, industries, and even countries. This can help to reduce your risk and smooth out your investment returns over time. Armed with this knowledge, you're one step closer to making an informed investment decision. And remember, the most successful investors are not those who make the most money, but those who make the most informed decisions. We've journeyed through the world of stock market investing, but this is just the beginning. We've explored the intricate realm of stocks, bonds, debt, and equity, each with its unique allure and challenges. But remember, this is merely the tip of the iceberg in the vast sea of financial knowledge. We discussed the magnetic pull of the stock market, its potential to transform modest savings into substantial wealth, and its role as a catalyst for economic growth. We delved into the risks inherent in stock market investing, the volatility that can turn fortunes upside down, and the importance of diversification to mitigate these risks. We compared traditional investments with stock market investments, highlighting the potential for higher returns in the latter, albeit accompanied by increased risks. We unveiled the critical difference between debt and equity, two fundamental concepts that every investor should comprehend before venturing into the stock market. The journey was not all about allure and risks. We also emphasized the importance of due diligence. We underscored the need to understand the crucial parameters before investing: the company's financial health, market position, growth prospects, and the economic environment, to name a few. These aren't mere numbers or statistics on a screen. They are the lifeblood of informed decision-making in stock market investment. The world of stock market investing is a thrilling ride, filled with ups and downs, triumphs and setbacks. But it's not a journey to embark on lightly. It requires knowledge, understanding, patience, and a healthy dose of caution. It's not about chasing the next big thing or jumping on bandwagons. It's about making informed decisions based on solid research and understanding. We hope this journey has sparked your curiosity, equipped you with valuable insights, and inspired you to delve deeper into the world of stock market investing. Remember, the stock market isn't a game of chance, it's a game of skill, strategy, and knowledge. With the right knowledge and a cautious approach, the stock market can be a powerful tool in your financial arsenal. Are you ready to take the leap?